How to make or lose money with penny stocks trading. As you are probably already aware, penny stocks impart bigger risks but might in addition offer broader return on an investment. So this really implies that you might either lose a lot of your money by investing in penny stocks because of the increased risk component or make a large amount of money because of the higher possible returns. Which of these happens to you will rely on a great deal but not only on how you approach evaluating the investment. So before we make a move, you ought to be aware that regardless how much care you may take, there is a particular amount of chance associated with penny stocks that is much bigger than in the case of large capital, stock exchange qualified stocks. So before you're able to evaluate whether you can produce money out of a penny stock, you ought to understand how one produces a profit in the stock exchange. The benefits that one gets from a stock investment is in the variety of dividends. That nevertheless, is usually a very tiny share of the returns that a person receives from stock investment. The leading issues come from growth in the price of the stocks or shares, and the prices of stocks or shares are measured using different yardsticks. The foremost of these is the return on investment funds. So if the return on a stock is 10% and the value earnings ratio is 10, for instance, the stock would be valued at 10 times the earnings or 100% of issue price. In other words, this stock would be bought and sold at its face value, and from this we can observe that the value would reckon on two things: the total return and the price to earnings proportion. The second important element that affects the monetary value is the book value of the stock, which is basically computed as an amount that represents the assets accessible in a company against each stock. To provide an example, if a company has net assets of $100,000 and has supplied 10,000 shares, the cash value of each share with this technique would be $10. The cost of a share is in addition evaluated on the base of a few other measures. However, the most important element from the market point of view is the issues that the stock establishes. The cost under this method would rely on the earnings and the price-earnings proportion. The latter is a topic of perception that will reckon on the risks linked with the stock. This perception will go through changes depending on the history of performance of the administration, the accessible information regarding the company, its prospects, and the market buzz about immediate big events in the company, for example the takeover by another organization. From all of these, the most important from the lasting viewpoint is the consistency and amount of earnings and the path of the price/earnings ratio in the short term. As a person can to invest, the things you need to evaluate and be aware of are: 1. After everything, is the company is healthy enough to sustain its profit and development by discovering who its promoters are, and how long it has been established. 2. Just what is the market perception of the business and is it probably going to change? 3. Can you find out if the company has a good foundation and enjoy reliable growth? In conclusion, the old saying "don't put all your eggs in one basket" is right to a greater extent in the case of penny stocks, so save a little at a time and do not invest your funds on one or a few such stocks.